Hi, everybody, and welcome to another trading education session. Today, I want to go over an intro to technical analysis. Now, this won't be as in-depth as the 2-hour courses I offer on an intro to TA, but this is meant to give you a high-level overview of the basic tools that are most important in everyday technical analysis. And the goal of this really is to get everybody up to speed with a base level of knowledge so you can improve your charting and your trading. And by getting everybody up to speed, I'm hoping to offer more advanced technical analysis courses in the future. So this is meant to be a baseline for you, but there is so much more to study. Every one of the topics that we are going to cover today, you could spend hours on, just on trend lines, on volume, all of these things. So this is a very high level cursory overview, but it will really get you equipped to start charting with more precision and to really know what you're seeing and looking for at those overbought or oversold periods to help identify turns and trends, price targets, and some of the basic things we do. Now, no one can see into the future. TA is a tool, just like analyzing the macro. It's meant to increase our odds of being correct. When we see confluence in indicators and trends, that stacks the odds in the favor of our thesis being correct in one direction or another. And it gives us a probabilistic outcome to act on for our trading decisions. And if we are incorrect, we need to adapt because the charts are doing the opposite of what is expected. And that in and of itself is a massive signal. So you'll often hear me say in my YouTube videos or put forth a thesis in my YouTube videos of, I think the price is going to bounce here and then go to this level. That's all well and good. And it gives me something to act on when I'm making my trading decisions, but I need to hold to that loosely because ultimately, with all things charting in TA, price action is king. And if the price action is showing us something different than what our thesis was, we need to be ready to adapt quickly. If we hold to our thesis too dogmatically, that is a recipe for disaster where you can really get hurt on a trade. Now, learning the skills of technical analysis, that's honestly the easy part. If you spend a bit of time with it and you put it into practice, you will relatively quickly be able to see these patterns in the charts and it will become much more second nature. The hardest part in trading, and I say this a lot, is mastering our emotions. That is the most difficult part, and that takes years depending on your personality and your temperament. But TA really helps with the emotional side as well. If a stock is running up and you see that the RSI is overextended and we're getting into a resistance line, and then all of a sudden we have a dramatic pullback, it's no longer as scary because you anticipated that already being the most likely scenario on the charts, and you have hopefully planned a couple of steps ahead to be ready with your trading game plan. Now, if there's one thing I really hope you walk away with today, it would be seeing how everything on the charts is interrelated. The time frames, the indicators, everything else, it's all interconnected, and all of that connects back to price action. And as well as everything in terms of the indicators relating back to price action, also all the time frames we use on the charts are interconnected. It's a bit silly, but I often refer to them as Russian nesting dolls, where we have the weekly and then the daily and then the 4-hour and then the 1 hour, 30-minute, 15-minute, 5-minute. You get the point. And the larger time frames are the most important. So when I'm building a thesis of what the price action is doing, I'm usually looking at the daily. I'm saying if the daily is in the middle of an uptrend, it increases the odds that the price action is going to be moving in that direction on the smaller time frames. But within that, when you're in an uptrend on the daily time frame, the 30-minute chart or 15-minute chart can have several trips from the bottom of the RSI range to the top, back and forth, and you can have little mini up and down trends, which I'm trading all the time for perps. So time frames are interrelated, and all our indicators are connected in some way to price action and influence one another. If you are brand new to TradingView, parts of this might feel a bit advanced, and that's perfectly okay. I want you to focus less on the software interface and how we use that today, and more on what we're seeing in the price action on the charts and how we're applying the tools. If you don't know how to use TradingView, there are plenty of resources online, on YouTube, or you can find coaches to help get you up to speed with the software itself. But today isn't meant to be a demo on the software. So I'm going to assume you have a basic knowledge of how the tools within TradingView function. Also, the tools will already be set up on my chart. If you don't have indicators set up in the fashion I do, I have another video on how I set up all my indicators in my charts on my trading education playlist. I will link that in the description below this video. Now, the last thing I'll say before we get into the charts is that crypto charts and equity charts behave slightly differently in terms of the price action. Crypto has these extreme events where you have blow-off tops and these fear bottoms where the selling or the buying is just out of sync with the rest of the price action on the chart. And there are lots of tools in technical analysis as to how we draw trend lines, apply price targets and patterns. And sometimes, just with crypto charts, this doesn't apply to equities, I ignore some of those spikes, and I'll point that out as we get to that point in the lesson. But just remember that this is the difference between book smarts and street smarts. Book smarts say this is exactly how you have to apply trend lines 100% of the time, and street smart says this is how we generally apply trend lines. And there's this extreme event that doesn't align with the rest of the trading, so we are going to take some liberties here to apply trend lines in a way that makes sense. All my charts for the demo today are set up on the linear scale. A lot of technical analysts use the log scale because it is a little bit more precise. If you're going from a $10 price to a $20 price, that's 100% gain in the asset, obviously. But if that asset keeps moving up, then the next 100% gain would be, well, not literally, but the next 100% gain might be from $100 to $200, which would appear much larger on a linear scale. So folks like to use log because it evens things out percentage-wise, and particularly if you're analyzing an asset over a long time frame, say you're going back 3 cycles in Bitcoin's history, you would definitely want to defer to the logarithmic scale on your charts as opposed to the linear scale. So just a quick note there, but let's get into the charts. All right, so starting here on a blank Solana chart on the 4-hour time frame, and I've got my video turned off today so we can really just focus on the chart. You don't need to look at my ugly mug. And I also have most of my indicators turned off, including the InvestAnswers suite, because all of the TA we're going to do today is done with simple tools and trend lines within TradingView and some basic indicators like RSI, volume, the VRVP. Again, if you are not familiar with these tools here, the VRVP on the right, the volume on the bottom, go to my trading education playlist. Again, it's linked in the description of how I set up charts with all these tools. And then I also have the 200-day moving average on the price action right here. And what we identify in the price action today, it's meant to complement any indicators you might be using. We want to move beyond just acting off of buy and sell signals within indicators to really make informed decisions and to shore up our thesis. If we're getting a green or a red triangle, we want to look a bit beyond that and say, well, what's the raw price action saying? And does it confirm what I'm seeing in my indicators? And most of the time, the answer is yes. But there are instances where you might see some conflicts that would cause you to pause. And overall, this is going to increase your odds of being correct in any trade you take. So we're starting with the raw price action because everything on our chart, the indicators, patterns, volume, it all derives from price. And understanding raw price movement gives us the clearest picture of market sentiment, and it's the basis for all of our TA skills. That's why simple tools like the trend model or optimized trend work so well, because they just give you a visual indication of if price action has shifted, but we can identify that on the charts through price action as well. But before we do that, I think it's important to just take one beat to understand what is happening on the charts here and how candles function. So we're zoomed in here to the price action on Solana, and I am using standard candles. You can also opt to use bars, hollow body candles, or volume candles, but when doing TA, we never want to use the line chart or anything like Heikin-Ashi candles because those average out the price action, and we want to get precise opens and closes, and we want to see the full range of price action for each of these candles. And the way a candle functions, since we're on the 4-hour chart, obviously each of these candles accounts for 4 hours of price action. And if we're just looking at this tall candle right here, this price right here at 191.46, that is where the candle opens within that 4-hour window. And right here at 196.89, that's where that candle closes within the window. These wicks that we see to the top side and the bottom side, those are the extent of the overall price movement within that 4-hour window. But the price opened here, closed here. And then the next candle, obviously, if you close this 4-hour candle at the 196 97. That next candle would open at the same price. Then you can see all of the variance in the price movement throughout that 4 hours. Then it closed and the next candle opens, and we just keep going like that. And there is much to be said about reading candles and how you can spot reversals and engulfing candles, all these kinds of things, which we unfortunately don't have time to get into today. But just understanding how candles function is the basis of reading price action. Now, the next thing we have to do, if we're zoomed back out, is identify the trend we are in based on the price action. And often in my classes, I'll say identify what kind of trend we're in currently. Are we in an uptrend, a downtrend, or more neutral consolidation? And the answer is it depends on the time frame you're on. And now we are on the 4-hour time frame, but we are really zoomed out. We're seeing all of the price action for 2025. So really we should be on this time frame on the daily for all intents and purposes. But I want you to take a look at all these swings here. And I would suggest that since the 7th of April, we have been in an uptrend because we have been making higher highs, higher lows, higher highs, and hopefully now a higher low. So that is the structure of an uptrend. But if we were viewing this just on a 15-minute or a 1-hour chart, you would say that we are in a downtrend because right now you have a local downtrend marked by this is our high, then we make a low, then we have a lower high, a lower low, another lower high, and we should really zoom in more on that, and then a lower low, and another lower high. And now is the point where we're wondering, we're on the 200-day moving average. Is this going to be a turning point where we make our first higher low and perhaps a higher high? So if we're just projecting that out, that would mean we bounce here, make a higher high, another higher low, higher high. That is a change in the structure and the price action. But if we go back out and we look at all this price action, I would say it's not confirmed that we're in an uptrend yet relative to the highs that we set back at the end of January at close to $300 for Solana, because we had this massive downtrend that made these new lows. And locally, sure, we are in an uptrend right now, but until we pass this peak of $300, I would say, on a weekly scale, we can't say definitively that we are in a fresh uptrend. Even if you would have asked me about this price action here since April 7th, if we came to this a couple of weeks ago, and let's just use the replay tool to go back and say this was our price action, I would say, well, it looks like we are trying to recover, but this isn't a confirmed uptrend to me yet because we have just made this one higher low, but we haven't made a higher high yet. We haven't passed this previous swing right here. So until I see that confirmed, even on a smaller scale, I'm not comfortable saying we're in an uptrend because there is very much a world in which we could reject and then continue in a downtrend from all this price action. Thankfully, that didn't happen, but it's something you always need to be aware of and not get too bullish on the larger time frames until you have that confirmation. Now, within all price structure, the other thing outside of just lower highs, higher lows that we need to recognize is that everything is constructed of two basic structures, and that is impulsive moves and corrective moves. And what I mean by an impulsive move is something like this that moves away rapidly, definitively in one direction. And a corrective move is something like this that is marked by a lot of indecision and overlapping price action. So an impulsive move is a strong directional price movement that shows clear dominance by either buyers or sellers, and it typically occurs in the direction of the prevailing trend, and it's marked by urgency, these much larger candles that we see as price action is moving up, and also traditionally increased volume. Normally, when you see impulsive moves, you have spikes in the volume, and when you have corrective moves, often you see lower volume zones, as we see right there. If we zoom in a little bit just to sharpen that up, anything in an impulsive move is also generally marked by longer bodied candles. It breaks previous highs, so we're breaking these highs in the range as we have this impulsive move up. And it often follows consolidation, as we see right here, or a breakout, and is accompanied by that higher volume that we mentioned down here. There are also minimal pullbacks within impulsive moves, so sure, we get a few overlapping candles right here, but you're not seeing big corrections. And impulsive moves can also play out to the downside, as can consolidation. Now, a corrective move is temporary retracement or sideways consolidation that sometimes goes against the trend, and it's weaker and it shows indecision or a pause in the trend rather than a reversal. So yes, these consolidation moves can sometimes pull back a little bit, but you're not broadly retracing the move in its entirety. And if we just compress the price action a little bit, you can see again here we have these impulsive moves, corrective move right here, a little bit of an impulsive move, and another corrective move, and then another impulsive move. Sorry for my terrible drawing skills, but you get the idea of the basic structure there. And these corrective moves are marked by these smaller overlapping candles, a choppy structure, lower volume generally speaking, and they often form flags, wedges, or channels, and it doesn't break generally any key structural levels, so it usually plays between support and resistance ranges. If we go back to the old adage of markets spend 80% of their time figuring out where they want to go and 20% of their time getting there, well, you can see that those corrective moves are that 80% of the time, and this is our 20% of the time getting there, which is much more exciting. So the next thing we have to talk about with price structure is support and resistance identification, because that determines a lot of these zones where we'll get the impulsive moves to move up to and then move up and pause. That's all based on support and resistance within the chart. So support and resistance identification, with that we're looking beyond the price action of the candles to determine which zones in the chart are most likely to be our next stopping points, resistance overhead on the way up, or our support on the way down. These are the levels where price reacts most consistently, and they form the foundation of our entries, exits, and risk management strategies. I often love to look for entries where the daily or 4-hour RSI is oversold and we're getting into a support level. That just increases the odds that you're not going to break through when you're seeing other indications of the charts being oversold. And if you are getting to a support or resistance level and you aren't overbought or oversold on the RSI, that increases your odds of most likely going through that zone. So first off, to draw support and resistance, we can do that just based off of the raw price action. And if we're looking at Solana here, and this VRVP is helping us cheat a little bit because it draws this line at the most traded zone, but that's a very obvious level right there, right? We see all that support that we found on the price action, and we could even move this down a little bit. We could say it's maybe right here, maybe in the middle of the range, and our VP is drawing it right there. For Solana, because I've been trading it so long, I like to draw it here at 141. It also aligns with a 50% level, which we'll talk about just a little bit later. But the important thing I think to remember with these lines and support and resistance areas is that it's not an exact dollar and cent value as much as it is a range in which you can anticipate support or resistance kicking in. So if we're just going back in time a little bit, you can see we have some points where the price action reacts very precisely to this line, and other areas like right here where we wick above a little bit. So if we're just using our imagination and we draw a little bit of a range box, you could say, oh, maybe this is our zone for support and resistance in that price range. I don't always draw these boxes on, but it's just a way to visualize it. Now, another area is actually where our price action is right now. See all these previous peaks on Solana right here at 164 and change? That was our major breakout to get to these recent highs. So that would be another area where we can just manually draw in some support and resistance. And then also from this recovery from April 7th up to the beginning of May, I would put our resistance zone, somewhere in this ballpark. I'm just looking for an average of the candles. You could even go with this peak here in the middle, but let's say 177 just to get in the middle of the range. And again, that's a ballpark where we are giving it some tolerance. And let's see what else we have here. We could also identify this area right here with all these previous peaks. And where was that? That was right there. Okay. And you don't make your chart too cluttered, but we want to get good about identifying these areas. And now you can see how a lot of our corrective moves or consolidation fall between these zones here. And the interesting thing you'll find is we haven't looked back in time yet, but let's go back on our chart. And if we go back in time, wow, look at that. We're finding support right here. We are consolidating a little bit right here. We found all this support at this line right here. And we're roughly consolidating in these same areas, finding some resistance right there. So you can see how these price-based support and resistance lines carry through over time, and these will still carry weight for us into the future for many weeks, months, maybe even years of price action. Now, one thing to note with these lines is that they can often flip in terms of their character. So if we're looking at this line right here, it played support, support, support again, and support. And then we broke through, and it played a bit of resistance as we came back up. And luckily, it wasn't too tough to break back through on the second attempt. And then it played support again. But you can have that change in character. Again, right here, as we break through this overhead line, then it plays support for us. Then we break through, it plays resistance. I would also count this as resistance, but it just had some momentum pushing through, and another area of resistance. And now on the way down, we only got one candle of support. Really, it didn't hold up well for us. And then it played resistance for all those candles in there. And now we're back to resistance. So you can just see how those areas change character over time and flip from support one way, resistance the other way. Now, the last way I draw these support and resistance levels is also off of psychological levels. So I would suggest that 200, where's 200 here on the chart, as a round number is a psychological level. And then you could also draw this, say, at $100, which, where are we here for $100? Oh, we have to go way down for $100. These kinds of round numbers can often play support and resistance as well. You can see we had a little bounce off that there. Let's just look at that $200 number to see where that was. Yep, it was a bit of resistance here, a little bit of resistance on the way up, a little bit of support. They're not quite as strong as the numbers we're drawing off of raw price action, but we should always be ready to anticipate a little bit of resistance or support around those psychological numbers as well. Now, the other way we can firm up where these levels might be is just based on the VRVP tool here, which is the Visible Range Volume Profile. And as the name very literally would suggest, it accounts for all the visible price action. So if I compress the chart to bring in more price action, you'll see how the VRVP tool adjusts and it gives us those volume ranges. And this is accounting for buy and sell volume within these ranges. The blue accounts for the buys, the yellow accounts for the sells. And wherever we get a spike in volume, those are our highest volume zones. And because of that historical trading volume, we can anticipate support and resistance there because of all the historical buy and sell action. And a lot of these spikes in the volume often align with those support and resistance zones that we have already drawn in. And another thing you'll notice here based on the VRVP, if we go back to drawing another box and we just take this volume cluster right here and we draw this out, you can see how that very accurately corresponds to our corrective moves or our points of consolidation. And then if we look at a lower volume cluster like we have right here, that corresponds, generally speaking, to more impulsive moves where we're cutting through that price action a bit more quickly. And if we bring this up to, say, the top of the range right here, I would say in this zone right here, we could also anticipate a bit faster action of the price action cutting through that zone and not consolidating quite as much. So that's another way you can use the VRVP. We don't have really time to get into volume analysis for the volume here at the bottom, but just know that this volume here corresponds to each candle right above it. So let me just zoom in a little bit. So this big green candle, it corresponds directly to the 4-hour candle above it. And this is aggregate volume. So within that 4-hour candle, it's accounting for all the buy and sell volume and is showing that you have a large amount here based on this candle. And it's tinted green or red just based on the majority of the volume. So here, green, at least 51% buy volume, red candle here, at least 51%, probably more sell volume. And these big volume spikes, they normally correspond to turnaround points in the chart. So that doesn't mean a full trend reversal from a bearish trend to a bullish trend, but at least in the short term, that you are going to get a near-term local turnaround in the trend for a shorter amount of time. You can see these volume candles here near the peaks usually correspond these spikes in the price or this extreme drop right here. We have another big volume candle and we had a temporary turnaround before continuing the downtrend. You also see big volume spikes on breakout of ranges. Looking right here, we had a classic fourth time breakout. I talk about this a lot in my YouTube videos, and we'll come back to this in a second as we get into trend lines. But we had touch point 1, 2, 3, and touch point 4. Often price action will break through on a fourth time retest of a trend line, and it is normally accompanied by a more meaningful move that you also want to see followed through with volume. And you can see on that breakout candle right there, we had a good volume spike, confirming that as a genuine breakout. If you ever see a breakout and there's no volume behind it, it is most likely going to be a fake out and just temporarily break the trend line before reversing in the other direction. Now, these horizontal lines are what I would consider static support and resistance. There is also dynamic support and resistance, which is not as strong, but that would be a moving average, like this 200-day moving average that is evolving over time as we get more price action printing, and also the confluence model clouds that we use in IADSS. This is dynamic support and resistance, where you can see it does play support and resistance, but it is continually shifting. And this doesn't carry weight over time nearly as much as these horizontal levels. It might, play a bit of resistance or support at the exact candle that we're looking at, but it is continually shifting and evolving throughout time. Now, the last way we can get support and resistance levels is by drawing Fibonacci retracements. I have a whole separate video on Fibonacci retracements and extensions, so I won't get into that too much today, but just so you can see how that functions, if we use a Fibonacci tool and we draw out our levels here, this would be for this major swing. We have our 50% level, which is an important level, at $195, so that's one to pay attention to. But I think if we draw that to this next swing, that will sharpen up the point a little bit more because you can really see the price action interacting with that. And here we go. You can see how our 50% level is actually right in line with this other support line we drew. The 618 is right near this other support resistance line we drew. And you can just see how the price action finds support and resistance at these Fibonacci values. Now, these don't carry weight across time as much as the price action based values because they really just relate to each individual swing. And those levels we just drew don't really apply to our local price action. If I'm assessing this local pullback for support and resistance based off of Fibonacci values, I would be drawing that to this swing right here. And you can see where we're getting all our levels there. But again, I have a separate video on this in my trading education series, so you can look for those under that playlist on YouTube. Now, the next kind of support and resistance we can draw in are trend lines. And trend lines are support or resistance lines that we put on the price action. And if we're just looking at this bounce in Solana from the 7th of April to the end of May there, you can see this is our underside trend line. And this is an example of what I was talking about in the intro, the difference between street smarts and book smarts. Book smarts would say you always want to draw a trend line from the major peak or trough of price action. But if we're trying to marry that up to the Solana price action here, you can see how it just doesn't align. So if we take that extreme fear, high volume event out of consideration, because we know crypto can react in these extreme ways, and we just take the next little trough right here, that works much better with our price action. And for a trend line to be valid, you need at least 2 touch points to speculate where that trend line is going to be. And then you need a third time bounce to validate it as a trend line. And then you can see we had another 3 bounces before we eventually broke through. And as price action is evolving, I'm looking for how this might be forming. So I might draw it here at first. No, it fails. Draw it here, and then draw it here. And then finally, that establishes our trend line from this bounce point here. And this is also happening as our 4-hour RSI is bottoming. I'm sorry, not our 4-hour, our 1-hour RSI is bottoming. So we'll look at that in a moment to get confluence there. And once we break down from our trend line, these trend lines often get back tested, meaning that you break down, back test it now for resistance, and then continue to move away. If we're looking at that in a downtrend, you can draw that as overhead resistance, like that right there. And you will see the same thing happening in reverse. When you break out of that line, now you back test it for support and move away. And we can do that again right here. And there you go. This one isn't quite as clean. We wicked above it just a little bit, but broke through, back tested it for support, and then continued to move away. Now for our current price action on Solana, where would our trend lines be? And we had another extreme fear bottom. This was the Israel-Iran conflict. So again, I would be drawing my trend line off of this wick here and lining it up like this. And this would be our major underside trend line, which we broke down from a couple of days ago. Similar to this correction here, this one ran for 6 weeks. This one ran exactly for 30 days. Incidentally, this correction ran exactly for 30 days. Time analysis is very important in technical analysis. It's not something we're going to get into today, but if you want to look it up, it's a very powerful tool to just give you an idea of when to anticipate turnarounds. And right now for crypto, that for me, actually last Saturday, I was looking for a bounce because it was 10 days from the top. So a third of the time from that 30 days up, you can often anticipate a bounce, but I'm still thinking we have a little bit more to correct. So now I'm looking for that 50% of the time, which would be this Thursday coming up, and then 2/3 of the time, 20 days, which would put us at next Tuesday. So here we have Thursday, the 7th of August, and where's there? Tuesday, August 12th. So looking for those 2 periods for an ultimate bottom if we can't hold the 200-day moving average here, and this is just a little local bounce before a bit more correction. But going back to the trend lines, the point I want to make is that our price action really broke away aggressively here, and this is what I would call our major trend line, and then you can have a minor trend line within that. And so if we draw that in, you can see that right here. And let's go into the 1-hour chart just to really tighten that up to the price action. And my trend lines are a little thick right now compared to how I normally like them, but I want you all to be able to see them. So this played support, support. We had our third time retest for support and then broke down. I actually got into a fairly aggressive long right here because we were oversold on the 1-hour time frame. And then when that failed, I stopped out. I love trend lines in terms of points to trade on the chart because it gives you such a clear invalidation to set your stop loss when you're perp trading. And then we broke through, back tested it for resistance, continued to move away. And then right here, we tried to get support, we wicked through. And this was a tricky one because often things will wick through, and when they reclaim them, that's telling you that there's actually strength, and this might be a fake out and a reversal, but ultimately it couldn't do it, and we broke down. Didn't have a backtest here. Normally we have a backtest, and now we're finding a bit of support at our 200-day moving average. Now, if we're wanting to use these to determine if we might be correcting, let's remove this trend line. I'm now going to draw that overhead resistance, and this would be our major overhead resistance that we need to reclaim. And then we can also draw minor overhead resistance. So that next one would be right here. And look at that, actually. We just broke out of that one and we back tested it, and we're at the 200-day moving average. So this is a strong point if you're getting confluence with volume, with RSI, which I haven't looked at this afternoon, to perhaps play a bounce off of that line. And let's just take the opacity down on this one a little bit since it's a minor trend line, so it's not as important. And then you can even draw that here on this downtrend. And let's zoom in a little bit. I might not have drawn those completely accurately, but they're close enough right now for these examples, right? And as we're in this downtrend and it's increasing in terms of its clip, Now I can see, okay, we're mounting a little bit of strength. We've broken this first trend line. We are finding a little bit of resistance at this level that we've drawn in at the $164 level, but we have broken back above this other minor trend line, and now we're back testing it for support. So that's a good sign. You still obviously have this resistance overhead, and we have a little bit of work to do. But often the price action-based trend lines can move relatively quickly, and I would anticipate then we would get up to this next trend line and start to find resistance there. We also have this large volume cluster overhead. And if we break down from this trend line, that's giving you the opposite signal. Even though you would anticipate support right now at the 200-day moving average at this trend line, if that fails, that's a big counter signal that despite strong support being there, if that breaks down, you need to change your thesis and we need to look below. So then I would be looking to this trend line here at 153 and this next trend line here at 141 for potential support. And there are actually also some topping patterns, which unfortunately we don't have time to get into all those today, but some of those are pointing to that 140 range. So it's something I'm paying attention to. But again, I'm letting the price action lead. And if Bitcoin is looking strong, we might not get there. Last thing to say on these diagonal trend lines is that you don't want to put as much weighting in these as you do in these horizontal levels. These horizontal levels are a bit stronger, and these diagonal trend lines don't carry weight over time as much as the horizontal levels do. So just like we're thinking about time frames, with the daily chart being more important than the 4-hour or the 1-hour, the horizontal support and resistance levels are ultimately more important than these diagonal trend lines. And some traders don't even like to use diagonal trend lines. They just like the horizontal ones. So there are lots of approaches to TA, and a lot of folks have preferences. I like to bring all of them together, but you absolutely don't have to if it doesn't fit your style. Now, the next thing I want to bring in is the relative strength index, which is a bit similar to mean reversion, but it reacts with a bit more precision at exact tops and bottoms, where mean reversion sometimes gives you an earlier signal of things being overheated. But bringing mean reversion and RSI together is quite powerful, and it's one of my favorite ways to trade. And you can see that the RSI generally takes these trips from the bottom of the range to the top of the range, bottom of the range, top of the range, bottom of the range. We're not quite bottoming out. Right now, the RSI has been in this uptrend since February on Solana, and this will be different for all charts. And we have found support from that trend line a couple of times. If we do continue to correct here on Solana, and we have a little bit more ways to go, and we mapped out the 150 and the 140 as those next levels underneath, if the daily RSI is getting into this trend line, that's telling me that that might be a good bounce point. But if we were looking at this a couple of weeks ago and we were in this uptrend, and let's just imagine we came into the price action right here, and let's use the replay tool just so we can really dial that in, I would say, oh gosh, we just bounced from the trend line. The daily RSI has not gotten to the top of the range yet. Clearly we're in an uptrend, and our bias on the smaller time frames should be to the upside. So then if we go to the 4-hour chart, the 4-hour chart, the RSI is still elevated. And one thing you'll notice on Solana on the 4-hour chart, when you're in an uptrend, the 4-hour RSI never bottoms. It only bottomed here on June 25th, 22nd, I believe. And last uptrend we had from April 7th to the end of May, right here, the 4-hour RSI bottomed on April 7th, and then it stayed elevated the entire time until we broke that downtrend right there, right? And then it bottomed. So just noting these levels, and we can draw a little horizontal line right here. And when you note that break of the level, we tested it, then broke below. That corresponded with this breakdown. So that's giving you a lead on what might happen. Now, the 4-hour RSI in this current uptrend, it had formed a level right here at 40. And so I'm assuming that we are still strong and this level would continue to provide support. And we actually just broke down from that as we broke down from this trend line. And we'll bring that up in a minute, but I just want to go to a few of the other time frames. And if we're looking at the 1-hour time frame, you can see right here we bottomed on the 1-hour. The 1-hour will still take trips from the bottom of the range to the top of the range to, where do we go? Bottom of the range. And then it would make its way presumably back up to the top of the range. Let's just play through the price action a little bit. Yep, see there it spiked to the top of the range. And so if you're perp trading, you can use the RSI on smaller time frames. Now we're coming back down, bottom of the range, and we are into that trend line. That would be a perfect buy just based on RSI getting to the bottom of the range. And you get more signals as you get into the 15-minute. Now we're at the top of the range. So just using RSI can give you an idea if things are overbought or oversold, but this 1 hour chart is taking multiple trips and giving you multiple entries for perp trades, while the daily RSI is still making just that one singular trip from the bottom of the range to the top of the range. So depending on the time frame you're trading, your strategy is going to adapt accordingly. So if I exit that, and let's go back to the 4 hour, because the example was just looking at our breakdown of this trend line that we had here that was holding us up on our major underside support in this uptrend. Well, we tested it right here and we broke down a little bit. And then when we ultimately broke down from that trend line, that was shortly before we would bottom on the 4 hour RSI. And now the 4 hour RSI does look like it's attempting a recovery potentially, but the daily might still have a little bit more time needed to correct and reset. So we just need to take this one day at a time. And for the 4 hour chart, that would mean that maybe we come back down and bounce somewhere before the bottom of the range to form a higher low and then continue up on the 4 hour RSI from there. All right, so the last thing I want to cover is just a few patterns and price targets, because patterns and price targets really help us shape up our thesis of what the price action is going to do in the near term. And if we look at this April 7th bottom, we have one of the most common topping or bottoming patterns, which is an inverse head and shoulders. So you have left shoulder, head, and a right shoulder. If this was at the top of a trend, you would see it play out like so, and then you have your neckline. Looks like a nice little set of mountains. Anyway, if we're looking at this from the bottom end, you draw a neckline across this pattern, and then you measure from that center of the head to the neckline, and then you project that out on the candle that breaks out. And where does that land? It lands right at the top of this range. Again, it's not an exact number. It's more of a range that we need to think about. And with each of these price targets, I always think, does this make logical sense with what I'm seeing to the left side of the chart? Because that's all the information I have, if we were mapping this out on the 12th of April here. And yes, it aligns with these previous peaks right here that we see in the price action and this trend line that we have drawn. If we go back in time, you can see how these previous peaks right here all align with that price action as well. So it's a logical target that I am going to take seriously. But the interesting thing about this inverse head and shoulders is as it formed, we actually got a larger inverse head and shoulders with another price target. So we have left shoulder, bigger head, and the right shoulder. You generally want these shoulders to be fairly similar in size in terms of the depth and the width of the shoulders. And if we map out this one here, we can just go horizontally across. And whenever you have an inverse head and shoulders with a horizontal neckline, it is slightly stronger than, say, the diagonal neckline we had here. And if we map that out like so to the breakout candle right there, where does that bring us? Well, it brings us to 178, which if I'm looking at this at the time, I'm like, oh, the 200-day moving average is there. That makes a lot of sense. Maybe the 200-day moving average will drop down by the time we get to that price target. And I look to the left. Oh my gosh, we have these two previous peaks that are exactly in the same price range. So it is a logical price target that makes a ton of sense, and that gives it more validity, at least in my book. Now, if we're looking at the top here we have what's called a double top, where selling pressure is coming in at a very even point. You might say, well, those tops aren't totally even. There's just one wick that wicked up for like 15 minutes, and it proves the point that sellers are really stepping in this range no matter how hard the buyers are trying. So to measure out a double top price target, we draw a neckline across the top. We take the valley in the center, map it out to that point there, and then project it off the bottom of the price action. Now, a double top isn't validated until you break below that lowest price point. So until we broke down right here, this wasn't a valid target, but it can still give you a zone to aim for. And in this downtrend, once this is validated, this had all the hallmarks of a bottom in terms of the charts being oversold on the RSI and we got mean reversion signals, but we hadn't hit the price target yet. So it was telling us to look out for potentially lower prices. And if we map out where that goes to, it went right to the middle of this Israel-Iran conflict bottom. Of course, it was an extreme fear event. We wicked below it a little bit, but for all intents and purposes, we really hit that price target. And then if we continue on in time, you could argue that, well, right here, we have another major inverse head and shoulders. And if you map that out, that gets our price target right up here to where we found resistance around $200. So these can be very powerful tools to apply in your trading. There are also plenty of other patterns within the middle of price action, continuation patterns like cup and handles. Here we have a wedge pattern in the middle, and unfortunately, we don't have time to cover all of these, but there's so much information online on these patterns and how to apply your analysis. This is a fairly neutral pattern in terms of it has pretty much a 50-50 shot of breaking out to the upside or the downside. But if we measure the breakout point, so right now I'm measuring the width of the wedge based on the touch point to the top and touch point to the bottom. I wouldn't count the wedge here because we didn't have a bottom touch point. So this is the conservative price target. Map it again to that breakout candle. Oh my gosh, it makes sense again. We're right at the 200-day moving average, and that was those local peaks of this little move. So this can be very valuable just in terms of a near-term target. If you're trading perps, this was one of the easiest trades I took in the last several weeks. All right, now I know I said those patterns were the last thing we want to cover, but I just wanted to flip over to the MicroStrategy chart to talk about identifying blow-off tops or blow-off moves generally, because MicroStrategy has great examples of those. And some of these rules can apply to Bitcoin as well. And while we're here, MicroStrategy actually has a continuation pattern playing out, which is a cup here and a handle, which is a continuation pattern after a strong move up. And we measure that off the top of the cup to the bottom of the price action, projected to the breakout candle. This is close to invalidating. If we were to break below the bottom of the handle here, the target would be invalid, and we would have to look for other support to the downside and then see just what the price action is shaping up to do. But we're here to talk about blow-off tops, not cup and handle patterns. And if we're looking at this blow-off top, there is a clear hallmark on equities to every blow-off top, and that is gap up opens, where you can see we have gap up opens here, here, and here. And whenever you start getting multiple gap up opens, that's telling you that you're getting close to a blow-off top. But there's a little bit more we can take away from this than just gap up opens, because that only applies to equities on the daily chart. Crypto, you don't get to see that because it trades 24/7. The other thing that's a hallmark of a blow-off top is increase in size in candles. So you can look at all our average candles over the last year. And what changes right here? Well, obviously we're already in a fairly strong uptrend, but it has good structure in terms of just that stair step of higher highs, higher lows, the whole way up, right? And then all of a sudden the clip increases and we just start going vertical in our price action. So the intensity of the price action to the upside, that increases. And what else? The size of the candles gets so much larger. Look at these candles compared to anything you've seen in MicroStrategy's history up to that point. There's no comparison. So seeing larger candles, gap up opens, and an increase in the velocity of the move to the upside, those are all telltale signs of blow-off tops. The other thing you can look for is increasing volume and a volume climax like this. This also works to the downside. Tesla, when Elon Musk and Trump had their big fight, it was into support to the downside and had its largest volume candle, daily volume candle in history. So that told me that we're into support. Based off that abnormal volume candle, I should anticipate at least a near-term turnaround. If we're applying this blow-off top logic to crypto, a couple of the same rules apply in terms of the velocity of the move and the larger candles. And the other telltale sign for crypto of a blow-off top incoming is shorter and shorter corrections. So a correction that may have taken a couple of weeks to recover from within the earlier part of a bull run will now get bought up in a day or 3 days. And it's just telling you that there's a lot of froth in the market and buyers are stepping in aggressively. So if you're looking at the speed of corrections along with the size of candles and the velocity of the move, those are all signs to you that a move might not be sustainable. And then we can marry that up with what the daily, weekly RSI are doing, what mean reversion is showing us, and we can bring all those pieces together to tell us that this would be a good time to get out. Or if that's happening towards the downside and everything's oversold and you get those extreme candles, that's a great time to buy because that's also not sustainable. All right, so that's it for the overview of the most important tools that I use every day when I'm working in the charts. I really hope it helps you in your own journey. If you want to take this a little bit further, there are plenty other resources online. Within the InvestAnswers community, there are wonderful coaches like Jacob and Mopbots and Josh and Mr. Dip and G De Niro. I hope I didn't miss anyone there, who offer classes. I have some group classes as well and some one-on-ones. I'm slowly starting to phase that out, but at least for the next couple months, I will definitely keep that going. It's just time is a little bit too tight and it cuts into my trading and creating of the YouTube content and all that. But I hope this is helpful. I look forward to seeing you guys in future trading education videos. I really hope to do a lot more of this free content to put online. Bye for now. This isn't financial advice. Past results are not indicative of future performance. Do your own research.